Thank you, everyone. Thank you.
All right, let's move on. Yes, to the next session. So it's the reverse. We discussed what companies do to climate change, in this order. And now we're discussing the reverse. So what climate change does to companies. So we're discussing vulnerabilities and adaptation. And to kick off the discussion, we have a panel, not a roundtable, then the roundtable. So Charlotte, and you will invite our guest.
Thank you, Emmanuel. Okay, welcome everyone, and it's my pleasure to welcome our two panelists. So please give a warm applause to François-Xavier Vucekovic and Pierre Abadie. Pierre Abadie is the Group Climate Director for Tikehau Capital. He has over 20 years of experience in the energy transition and climate investing. In 2018, he launched Tikehau's climate and impact platform. He spearheads now over 3 billion euros of assets under management in private equity, private debt, real estate, and climate markets, and capital markets, sorry. And François-Xavier Vucekovic is the Chief Investment Officer at Edmond de Rothschild Private Equity. He is in charge of developing private equity activities for Edmond de Rothschild for the last 15 years. And now his firm manages 15 different investment strategies with solutions to major environmental and social problems. So now I'd like to jump right into the second part of this session. Climate is already affecting companies or will affect them soon. It's not something that we are talking about which will happen in 30 years or so. It's already happening. We have entered a new climate era, an era where climate risks are more than a mere one-off disturbance from daily operations. These risks affect companies and the way they produce, the way they sell, the way they deliver their models, the way they integrate their supply chains. And they also jeopardize their facilities. Cash flow profiles of these companies are also affected, challenged, the more vulnerable. What used to be reasonably profitable businesses becomes less and less enduring. All this leads me to my first question for you, gentlemen, and then for our delegates to discuss. How do you approach vulnerability into your investment thesis and practices? And for instance, how do you handle the challenging alignments between 3 to 5 years investment horizon with the necessity to make the big decisions to address vulnerability?
Do you want me to start? Okay. So at Edmond de Rothschild Private Equity, we see private equity actually as a transformational tool, where we bring finance to the service of the industry. And I think what is important is really a matter of fact. So I will start with an example of a recent investment we've made in a company which maybe you know, which is Ticamoon. It's a French company, a producer and distributor of wood-based furnitures. It's a mid-sized company in north of France, and it's a primary investment. It was 100% owned by a family. Before investing, we made a full due diligence on the company, including ESG criteria, internally but also externally with an external expert. And we identified some vulnerabilities, and based on that, actually, we defined an action plan together with the management team. It's important to mention this is a collaborative approach with clear objectives and the remuneration of the management team based on the realization of this action plan. So this is really, to align actually the 3 to 5 years period with the management to be sure that we will realize the action plan. So in a nutshell, we identified three key vulnerabilities. The first one was linked to the production of the company. And so we want to limit the impact of the production. So how do we do that? We want to use less material in building the furnitures. So 95% of furnitures will be based off solid wood, and with no composite material. And we will use also more recyclable packaging, which is an important point. Second vulnerability was linked to the logistic and transport linked to the company. And here we implemented logistic centers close to rivers, and 70% of warehousing arrivals come by barge, actually. And 80% of transport is in bulk, so that we limit the number of journeys. And last point, we want to extend the lifetime of the products. So it's a change of the way we build them. We use more solid wood. We assess, the suppliers to be sure that they integrate in durability criteria. And furnitures are more repairable, which is very important. So by doing that, Tikahman will have a more robust business model, less vulnerabilities. And so you can see that we actually, by reducing these vulnerabilities, we create value on the long term, value for the investors, but also restoring the easier environment.
On our side, we will come back a bit from the global picture, and then to go very granular in terms of investing. I think that the main, I would say, mistake that we can do in terms of risk management is looking at the past to basically, predefine the future. And this is the big job that has done the IPCC, especially on the last report. If you look at the report number 2 on the risk, basically materialization of risk, I would say that you are not doing or fulfilling your fiduciary duty if you don't read this report, because that will show you the material risk of climate on all your asset classes. So basically, you will be able straight away by implementing and looking at this report on your asset class on the cut that you will have to take because it's physically exposed. What you need to do today is that you need to invest to basically shift the world from an unsustainable path that is currently on to a sustainable one. And this, you need to look at the mega trend of what is required. And now, in fact, we start to have the materialization of those plans from the IPCC into what it means in terms of investment. The people usually say that it's a cost. In fact, it's not a cost, it's an investment. If you look at the big numbers, in fact, IPCC or International Energy Agency tell you to decarbonize our system, meaning to be aligned with Paris Agreement, halving our CO2 emission by 2030, for example. So here we are speaking about a milestone that is like 2,500 days, so it's within our scope. We need to invest between the scenario between 4 trillion to 6 trillion per year. And we are currently investing 1.5 trillion. So as an investor, for me, it's a fantastic opportunity to invest, doing growth equity investment. I fully agree with you. When you do private equity, basically you are going to inject a concept that is euro into a value chain, and you are going to start to be transformative. So here what we are speaking about is that we've got a huge gap of financing. In fact, there is, when I hear people saying, well, is there enough project to finance? No, there is not enough money to make the transition that leads us to survive. And this is what we need collectively to bridge as a gap. Then what needs to be done, is already written by those people. In fact, we don't have to invent anything as finance people. Finance people are just collecting global saving, investing into the real economy. And what they say us, and this is the plan that we've got in Europe. In fact, we've got an ecosystem now that is ultimately fairly aligned with what is required to do. That's called Fit for 55, now REPowerEU. And the three main pillars are energy efficiency. Energy efficiency, you need to basically improve your energy efficiency by 40% the next 2,500 days. You need to increase the electrification of the end use. Why? Because what is emitting CO2 today is the use of fossil, it's not the production of fossil. It's the fact that we've got combustion engine, it's the fact that we've got gas boilers, it's the fact that we've got oil boilers. So you need to electrify those. Why you need to electrify? First of all, when you've got an electric engine, usually it's 4 times more efficient. If you take a heat pump, for example, it's 400% efficient. If you take just a gas boiler, it's 82% efficient, the best one. So structurally, by making the choice, you are participating to the first pillar. But then you are going to shift the oil demand. Currently, we are working on 80% fossil fuel to electricity. And electricity you can fulfill by low carbon sources. And here you got the 3 main pillars as defined. Energy efficiency, putting insulation on wall, changing windows, changing doors, putting heat pumps. You need to do that at scale. Electrifying all the end use, starting with the transport, and then fulfilling this electricity demand by renewable. What does it mean as for an investor? You take the money and then you capitalize a value chain. Why private equity is so important? Take an example. We've got a company called Amarenco, for example. They are doing like small-scale renewable, very small. For sure, when you do a due diligence, you are going to assess the physical risk, because since we are climate investor, per construction, we are aware that there is a climate risk. So structurally, in fact, we have that as a standard into our due diligence, which hopefully make us doing less mistake. But when I inject €1 into Amarenco, basically I capitalize the structure, then I've got someone that will provide the mezzanine, and then I will go into the project, and then from this euro I've got 2 as equity, and then it goes to the project, these 2 will do 10. So structurally, my impact as a private equity investor is 20 times the people that will lend at the project level. So on this company, we have been investing the last 18 months €200 million. This €200 million has currently transformed into a 5 gigawatts of pipe of projects, and 1 gigawatt currently being installed. To give you a data point, currently in France, there is 12 gigawatts installed as solar. So in fact, in 18 years, in fact, you can make significant change by using the power of the private equity and money into real assets. For me, the world is likely to change. I mean, we're speaking about huge amount of money. It's a global economy. It's roughly 80 trillion. When you look at the amount for decarbonization, 6 trillion, for the food and agriculture, 6 trillion, for protecting our asset base, 6 trillion, is roughly 20 trillion. So we are likely to shift from a consumerism economy that is globalized and very focused on its value chain to something that is much more capex intensive to change it to the sustainable way, which means that structurally, since the economy today, we stop putting more zero into it, it's likely to shrink a bit. So there will not be no growth. In fact, there will be an hyper growth of the sustainable aspect of it, and there will certainly be a loss on everything that is the old world. So for me, everything that is consumer goods and, for example, all those kind of things related to our consumption is likely to lose value over the next decade.
Thank you very much. Well, to sum up, what is vulnerability? What is it? In our opinion, we are talking about a company which faces climate-related hazards, either directly or indirectly, which may question its ability to keep doing business under comparable economic conditions and with, obviously, degraded returns, which François-Xavier was mentioning a bit earlier. Thank you, both of you, for your insights. For example, some sectors are already more affected than others. We are talking about, for example, construction, logistics, agriculture, but it's not the only ones. I mean, it's also applicable for specific activities, specific geographies, specific business units within your portfolio, and even business models that would actually consume too much energy or too much raw materials, such as Tikemon, for example. So based on that, what can you do? You can either do the work and protect, anticipate, transform the business models, the companies, or you can wait, and then basically vulnerable may turn into stranded. It may happen slowly, but it also may happen much more brutally. And from a list of potential risks that a GP has to live with, well, in the end, you may end up with severe cut on the value of your portfolio and your assets. So this is my question for you all. How could you integrate vulnerability into your day-to-day jobs? What would that mean, and what would you need for that? That's a question you may have to discuss a bit later. But moving on to the next topic, and from defense approach to more positive prospects. Let's look at the flip side of the coin. What about adaptation? Gentlemen, back to you. So what strategies basically are you building in your funds and with your portfolio companies to either source or accelerate the development of adaptive business models? Is it a strategic layer you intentionally look for when assessing new investment opportunities? How has it affected your portfolio monitoring process? And last but not least, are your LPs receptive to this type of evolution? Thank you.
Okay, so I think when we're talking about impact, what is important is the intentionality, the additionality, and the measurability of the impact. You mentioned the geographic approach. It's true that some geographies are more affected by climate change. And maybe I could mention what we do in terms of investment strategy in Africa through Ametis, where really our ambition is to transform structural vulnerabilities into opportunities. And as you know, Africa has a very specific climate context, highly exposed to climate emergency. Despite low level of greenhouse gas emissions historically, and low level of emissions. But we have to build adaptive models out of there. And so let me again be very concrete with a specific investment we've made in Morocco. Agriculture in Morocco represents 70% of water consumption. And as you know, Morocco is exposed to water stress. So the mitigation we see, we decided to invest in a micro irrigation company. Its name is Magriser. It's a small company based in Morocco, which provide actually water management services to farmers, to agri-food companies. And I think figures speak for themselves. They installed more than 600,000 pipes of micro irrigation. 100 cubic meters of water is saved every year.
One thing. I was just said that we have 5 minutes left for the panel, so very quickly. Sorry. Thank you very much.
Let's just talk about the impact. So it's equivalent to the annual consumption of 4 million of Moroccans we save through Magriser and its technology. So I think it's a good example of how we can actually transform those vulnerabilities into an investment opportunity.
Look, on our side, in fact, the strategy are very thematic, and somewhat it's an edge to protect yourself against making a silly mistake. I would say, finance people, we used to diversify risk. But today, in fact, this diversification is malfunctioning anymore. In fact, as I said, there will be huge mega trends. In fact, there will be winners. And then you will have things that are totally slashed because of the transformation that is required. When we do investment with a thematic, typically we've got I will give you very quickly 2 examples, but we've got one fund that is a decarbonization fund. Those companies are providing a service to our economy, either an energy efficiency service or renewable or electrification. When you invest into those companies, structurally they are auto-protecting themselves because they are asking themselves the right question. I've got one company, to make it very simple, it's called SETI. It's on the west of France in Nantes. Those people, they are making doors, windows, everything that is related to the individual house to reduce the carbon footprint of this house. Very high performant windows and doors, etc. They've got the trend Belém in France on Widen. They are doing a solar panel as well on the rooftops. Those people in their manufacturing process, they were willing, in fact, to since a while, it's a mission-driven company, in fact, reduce their own, ecological footprint. So, in fact, they are, optimizing the use of resources to do what they are producing. At the same time, their factory are very efficient, energetically speaking. They are having solar panel, they've got biomass, etc. And this was seen in the past when we invest by other investors like an extra cost. Why are you doing this? You want to produce more windows. You don't want to invest into a biomass boiler. It makes no sense for you. Yes, but in fact today you've got a price of energy that has been multiplied, in fact, by 10. And this company is currently using 30 to 40% less energy than all the competitors. So structurally, something that was basically, 2 to 3% of their cost structure, became from all their competitors 20% of their cost base, and themselves, they are, 10% cheaper. Since everything raised, in fact, your price of product raised, in fact, the price of your product is linked with your competition or the bulk of the competition. Therefore, what is the result of those guys having making those investments that were not strategic? It was just the way I behave, is an increase of EBITDA margin structurally. So you are living, in fact, when everyone is screaming about, "Whoa, I'm squeezed," well, basically, they are first on a market that is fulfilling a new demand, which is building thermal renovation, because everyone, now is willing to renovate. So in fact, their turnover is increasing. At the same time, when everyone is squeezed, they've got an EBITDA margin that is increasing. And this is not linked with the strategy of the company, it's linked, with the DNA of the company. And this is linked with the theme and the way that, we invest. It's not something that we decide or define, it's something that is just made naturally because those kind of people are asking themselves the right question.
Thank you, gentlemen, for sharing your experience. So basically every investor will have to make choices between the vulnerable regarding the vulnerable part of your portfolio, but will also have the opportunity to drive future exciting value based on climate opportunities and climate adaptation. To turn the tide in your favor, you may either choose to look at your portfolio, your current portfolio with the right lens, and then carry on the needed transformation, or you may also decide to source external opportunities to further mitigate the risks within your portfolio through build-up. These two options are basically the untapped opportunities for this new climate era. And my question to the room would be actually, are you currently equipped or already equipped to review your deal flow and your portfolio with this new approach in mind? And if not, what would be the first step to get there? Unfortunately, I think we won't have time to review the third question, but anyway, you already gave us a few examples within your portfolio, so thank you very much again, gentlemen, for this. And yeah, maybe a last word.
Yeah, we'll just give a last word perhaps for more the LP or the people that have got, or even the GP. At the end of the day, when we speak about climate and carbon neutrality and all those kind of things, well, just stop making pledge. The reality is that look at what you control. Within Tikehau, we control our balance sheet. So basically, we take our balance sheet, we decide to put our own money into our fund, focus on climate action. If you are a LP, in fact, you control your allocation. We know the numbers. We need to invest 6 trillion per year. You look at the stock of assets, today it's 130 trillion. So basically, instead of taking a carbon neutrality pledge by 2050, just allocate 3% of your stock of AUM to climate on a yearly basis, and you are aligned with Paris Agreement. As far as those investments are aligned themselves to what is supposed to be done, which is energy efficiency, electrification of end use, and renewables.
Thank you, both of you, for your insight and experience.